Let me now bring on board Dr. Montek Singh Ahluwalia. He's the Deputy Chairman of Planning Commission. He joins us live from Delhi. Dr. Ahluwalia, good morning. Thank you for joining us. Dr. Ahluwalia, just when everyone thought that Indian economy had bottomed out and we could be staring at a new growth cycle, we got a free fall situation. Rupee has plunged to a new low.
Well, you're catching me a little bit by surprise because you asked me to join this program mainly to congratulate ET now on his 4th birthday, and you've switched the subject to the rupee. What is it that we're discussing? ET now's birthday or the rupee?
Well, both, but I guess rupee is the burning topic, sir, so would really appreciate a comment from you on that.
I don't think I want to comment. You know, I think I've just heard Bimal. Bottom line on the rupee is, look, currencies are volatile everywhere, and currencies do move sometimes a little beyond what people expect. That is the job of the Reserve Bank to manage, and I don't want to add to speculation on what they will do and when they will do it. I think we need to watch the situation and see how the bank handles the problem. Now, mind you, I mean, what you're seeing, I think we should emphasize that you're seeing movements in the rupee in an environment in which, first of all, in medium-term context, there are many positive things happening in the Indian economy, and I think more is going to come in the next several days. And I think that's been noted by whatever the rating upgrade which Fitch announced recently. It's absolutely true that the current account deficit has been a source of concern, you know, in the sense that it's larger than is comfortable, and we expect that it will come down in the current year. I still believe that's the case. But you're watching it at a time when there's a huge amount of global uncertainty, partly connected with what the Federal Reserve in the US will or will not do. And I mean, you must have seen all the sort of commentary on the most recent announcement by the Fed. Markets are very nervous. I mean, markets are a bit surprised, have surprised people by how they reacted to the Fed's announcement. I mean, the Fed didn't actually say they were going to withdraw the stimulus, but somehow markets were very nervous. So, I mean, you do go through periods when markets are nervous, and that gets translated into volatility both ways in different parts of the world. Now, since our current account deficit is a weak spot, I'm not surprised that it puts a little bit of pressure on the rupee. I think we have to recognize that, you know, when the policy of the currency management is that we are not defending any particular rate, the real thing to ask yourself is not what is happening to the rupee yesterday or day before, because this can correct itself. I mean, you know, a year ago, the rupee had shot up to about 56 and it came down sharply. So I think currency markets have got to get used to the fact that just because the rupee has hit a low right now, I mean, the real question is, do they expect it to continue falling? Will it now stabilize? Will it appreciate? Now, actually, in a flexible exchange rate system, different people will make different assessments about this, and that will get reflected in the way the currency moves. There's no point government speculating on this when the policy that we are following really says, look, we're going to work on the macro. Lots of things we have to do, and frankly, if we succeed in what we're trying to do, and the macro improves, both on the supply side and in terms of fiscal consolidation, it will actually lead to a lower current account deficit. But from that, you can't judge what the market is going to do tomorrow and day after tomorrow. And I think that's really the way we need to look at it.
Fair point, sir. And thank you for outlining your thoughts there. But at Planning Commission, are you worried about the fall in rupee? The reason I'm coming back to rupee is not to get a price level from you, but a weak rupee means that we will only import inflation, and if we import inflation, that will only challenge the macro recovery.
You know, I don't believe that merely because you have an exchange rate change, it necessarily leads to an inflation. I mean, that depends on the extent to which the exchange rate change and the price of imported goods is fed into the system. It also depends on what the overall stance of monetary policy is. I mean, when you get an exchange rate change that is sustained, I mean, in other words, not just a volatility which sort of reverses itself. When you get an exchange rate change that is sustained, it makes imports more expensive. That makes domestic production more competitive. So more domestic production. That makes exports a lot more competitive. That means more exports. Now, while the exchange rate change may look like having a negative effect, you have to take into account the positive impact from making the domestic production that much more competitive. So I don't think that you can conclude from the fact that there's a change in the exchange rate that the situation is going to be worse. I mean, as a matter of fact, in many countries are being accused of maintaining an artificially low exchange rate. So the idea that an exchange rate movement in one direction is always a bad thing is not, I think, correct. It's not borne out by history or anything like that. And I would not call what you're seeing as a free fall, by the way. I mean, these are relatively small variations. We're not even the weakest currency in the system, and South Africa has seen a much larger depreciation. And virtually all the currencies of countries that had a current account deficit have shown a weakening relative to the dollar. But the dollar has tended to be strong. So, I mean, I think we're too fixated on the rupee-dollar exchange rate to get a real picture of what is happening.
Mr. Ahluwalia, why we are insisting on the currency weakness is because what that really does is it slows down foreign fund flows into India, and that's what market men have been fearing. Is India in a position then to finance its huge current account deficit if the flows do slow down?
That, by the way, is a very good question, and I will give you a very categorical answer. I do not believe that the ability to achieve a sustainable flow of funds is a function of keeping the exchange rate fixed. I think what will determine the flow of funds into a system is how people see the economy moving forward. I mean, in a way you could say that to the extent to which they perceive the currency to be a little bit weak at the moment, they might actually find a lot of buys in the country domestically which become more attractive, because in dollar terms, their asset prices fall. So I think it's completely wrong to say that the ability to finance the deficit is going to be affected by the fact that the currency has weakened. The real question is the weakening of the currency a reflection of fundamental weakness in the economy that is not being addressed? Now, quite obviously, if that is the case, then foreign inflows will be weakened. But that, in my view, is not the case. And in my view, if you step back and say, the currency is weakened, could it be that the economy is in bad shape? And you then made a careful assessment, and you're a foreign investor, and you look at India, growth rate is 5%, likely to be higher. And you look at Brazil, growth rate less than 1%, also depreciating. I don't think you would get the impression that India is not a place to invest in, at least compared with other emerging markets. Now, it's a different situation if there's so much global uncertainty that international funds flow into the dollar and nowhere else. Now, frankly, if you have a global situation of that kind, yes, we'll have a problem. We'll see if we have to handle it. I don't believe that you're going to have that situation. I just think you're looking at markets at a time when they're very nervous. I mean, look at all the international newspapers today. And what they're asking, the question they're asking is, somehow markets were nervous in spite of what Ben Bernanke said. So actually you're looking at a very, very highly volatile international financial market situation. So let's not be surprised that it has some impact on our own currency.
Oh yes, indeed. Fears that Fed would taper off has led to some kind of an indiscriminatory sell-off in all the asset classes, and India clearly seems to be standing out there. Mr. Ahluwalia, let's talk about growth. That is the real concern for economy. And for growth to come back, more than anything else, you need new capital formation. When do you think new capital formation will start? Because the IIP data or the sound bites which I'm picking from some of the top corporates are clearly indicating that capital formation or fresh capital formation is still a distance away.
Well, I think it's true that we don't see yet the sort of robust revival of domestic investment. You know, it's the most difficult thing in the world to predict when a turnaround is going to happen. Because generally when you're looking for a turnaround, by definition, you're concerned about the economic situation. And if a turnaround takes 2 months longer, you've got 60 days of 24/7 television saying, when's the turnaround going to happen, is it happening, etc. So I would agree with you that at the moment, there isn't evidence of a strong revival in investment. What should the government do? I think the government knows what to do. It's got to solve all these various structural impediments. Many have been addressed. Many, I believe, are about to be addressed. So I'm hoping that, say, by the end of June, and frankly, I had thought that we might be able to get this done a little earlier. But, you know, when you're getting difficult policy decisions through a multiplicity of ministries, it can take a little bit longer. But my feeling is by the end of June, we will have resolved a number of these things. They're all in the pipeline. They're all being talked about. Fuel supply problems, coal problems, gas price problems, FDI relaxation. I think by the end of this month, we would be in a position where at least investors would say, well, government has certainly acted. I believe on the fiscal side, we remain in a reasonably good shape. And then let's hope that it will lead to the kind of recovery of investment that is certainly needed. You know, I don't believe, by the way, that the recovery is going to come from people announcing new projects. Investment recovery is going to come when existing projects that have been held up start moving. I think when you get a downturn, what you have is a pipeline where a lot of projects are stalled. So quite frankly, the first sign of revival is that people who have projects which are stalled start signaling there's movement and start adding to the investment that they've been doing. New investment will come a little bit later anyway.
Mr. Ahluwalia, you just fleetingly mentioned gold. The government has taken only incremental measures to curb gold import, just about 8%. Do you think there should be a steeper hike when it comes to gold import duty?
Well, I don't actually have a view on gold. I mean, gold is not a productive asset in my view. And I think some of the data that I had seen did suggest that gold imports had declined. And let me say that, you know, a lot of the desire to import gold is simply because it's the easiest form of capital outflow. So it means that our capital account is actually more convertible than you think. I mean, technically, if you're an Indian citizen and you want to invest in dollar assets, you can take out about $200,000 a year. But, you know, that requires complicated decision making. You've got to know how the banking system works, etc. But if people just feel they want a secure asset and they think gold is a secure asset, they just go and buy gold in the market. Now, my view is that at present prices, that lure is already down. At least I saw some data from the Ministry of Finance, which said that I think in the first 3 weeks or something like that of May, the imports were running at about $139 million a day, and in the next 2 or 3 weeks, that was down to about $39 million a day. So that's a very big drop in gold. And I think gold imports will go back to normal. I mean, a lot of the big rise is the result of delayed build-up of expectation. You know, people sort of look at prices and they're not necessarily looking at what's happening last week. A sort of an attitude develops that gold is a good asset, and that's what has led to a lot of people buying gold. The government has taken some steps to discourage it, which is good.
Mr. Ahluwalia, what are your thoughts rather on the nature of flows Indian markets have got? Because we've not got too much of FDI inflows, we've only got portfolio inflows. The problem with portfolio inflows is that it tends to be volatile and short-term in nature. What the country needs, I guess, is a lot of long-term and solid inflows. How are you planning to address that problem?
You know, this notion that, I mean, I agree with you that ideally we should be getting a lot more FDI. But this notion that portfolio flows are short-term and volatile in nature is not grounded in historical fact. I think there's only been 1 year in the last 10 when you've actually had a negative outflow on portfolio. What has happened is it's been variable in the sense that it's gone high in some years and come down low in years. More volatile than FDI, but it is not as volatile as short-term debt. And you know, the moment you go into an open market type situation, an open capital market with, a stock market where you allow people to invest, and you have long-term investors who want Indian assets, there's not the same thing as investors who want to build factories in India, just pension funds that want to invest in Indian assets. The logical thing for them to do would be to build up a diversified portfolio of Indian stocks, sort of investing in the Indian economy on a long-term basis. I don't see any reason to believe that these are the same as short-term flows. The real danger is in countries which try to maintain a fixed exchange rate and finance the borrowing needed through short-term flows. Because as the exchange rate becomes more and more unsustainable, which happens if you were to fix the exchange rate, and you maintain the financing based on short-term bank flows, sooner or later somebody who's been lending to you decides, this lot is really in trouble, let's pull out. And when you have a flexible exchange rate, that's not what happens. When the rupee is 59 something to the dollar, sure, a lot of people speculate whether it's going to hit 60. But that's very different from if you had kept it fixed at 46 and you were then people were expecting a huge increase, a depreciation. So I personally feel that the present configuration, where we're keeping our stock market open, we're actually inviting long-term pension fund investors to invest in good Indian companies, not with a view to management, but simply put some money in across the board in a diversified portfolio. To call that short-term portfolio investment is just wrong. The real danger is if you have too much short-term debt. Now, it's true that corporates have been borrowing, not actually very short-term. Elsewhere where this problem has arisen, it's where the banks have taken short-term debt in order to keep financing the current account deficit. We are not in that position at all. So I think that's not something that we need to be too worried about. I think we need to keep our eye on the big real economy picture. Growth picking up, investment picking up, stalled projects moving, fiscal deficit remaining under control, inflation being reasonably controlled. I think as long as we do that, confidence will come back.
Mr. Ahluwalia, what about gas pricing? Because the cabinet is going to take it up shortly. Do you expect a $6.7 per unit level will be enough to attract investments in future?
Well, I don't want to prejudge what the cabinet will say. Look, we have a recommendation by the Rangarajan committee, and I think that recommendation is broadly sensible. They have suggested a transition. That's been our view. We cannot expect to keep gas prices insulated forever from global energy price trends. I think what the Rangarajan committee has said is long term we need to move to market prices, but in the interim they've suggested a new formula. I can't judge whether the cabinet will accept it or not, but I think it's definitely a move in the right direction.
Final question, sir. Since anniversary is the peg, ideally I would have loved to ask you this as my first question. This week ET Now is celebrating its 4th anniversary. Next year same time we'll be celebrating our 5th anniversary. Hypothetically, for our 5th anniversary, if you and me are engaging in a conversation, what kind of economy do you think we could be staring at?
Well, that's good. First of all, let me just wish you a very happy 4th birthday. If you were human beings, this is when you would be going to school. So, it's an important occasion to be discussing all these things. No, I think if you had a 5th anniversary celebration, I would certainly look forward to being able to tell you all that you should have listened to me when I said that the economy is on the way back up, that inflation is under control, and that the current account deficit is lower, and that basically for a year that has been pretty volatile globally, the Indian economy has been well managed. And on that, I wish you a happy 5th birthday.
Well, so I'm booking my appointment, my next year's appointment with you. Is that an indication? Should I book it right away?
Yes, certainly.